A fixed rate bond pays a fixed return for the life of the bond and is set at the time of issue. Hence, the rate or coupon is locked in and will not change over the term of the loan. They are similar to term deposits. The interest you receive is set. There is one key difference though. Bonds are tradable securities. Because of this, fixed rate bonds have an inverse relationship to interest rates. If interest rates rise, then the price of the bond falls. Alternatively, if interest rates fall, then the price of the bond rises. This is because the only way that bonds can reflect changes in the market's expectations of interest rates is through price movement. Important to note, when you buy a bond, the value of that bond may fluctuate. However, this does not affect the coupon rate. Let me give you a simple example. If you held a fixed rate bond and it paid a coupon of 6% and current interest rates were 4%, then the market would value that bond more because it is paying 2% above the current interest rate of 4%. Alternatively, if interest rates begin to rise and they rise above the coupon rate of 6%, then that fixed rate bond would decrease in value. Nevertheless, if you hold the bond till maturity, you'll receive your $100 face value. Floating rate notes pay a coupon that's linked to a variable benchmark. The benchmark is the 90-day bank bill swap rate, BBSW for short, and it's just simply the bond market's cash rate. The margin over the benchmark is fixed, and it's set at the time of issue. This is also known as a coupon. The coupon rises and falls over time. This is because the bank bill swap rate changes daily. It is the market's view on interest rates. Let me give you an example. If the market believes that interest rates will increase in the near future, then the bank bill swap rate would also increase. If the market believed in the future that interest rates were going to fall, then the bank bill swap rate will also begin to fall. The key difference here is that floating rate notes have much less interest rate risk, and this is because their coupon rates increase and decrease with the market's expectations of interest rates. Inflation-linked bonds are securities that are linked to the consumer price index, or inflation. The most common type is the capital indexed bond. The capital index bond has a fixed coupon and it's usually quite low, usually between 2 and 3%. However, the principal is linked to inflation. Each quarter, the principal component increases with headline inflation. The coupon is then multiplied by the increased principal component. Let me give you an example. If you bought a capital index bond for $100 and the coupon was 5% and inflation for that year was 10%, then the value over that year would have increased to $110. You would then multiply the 5% coupon by the increased principal component of $110, which will then give you a rate of $5.50. Hence, not only is your principal increasing with inflation year on year, but so is your income. So in summary, we have fixed rate bonds that pay a fixed rate over the life of the bond, and price is mainly affected by interest rate movements. We have floating rate notes, which move in line with the bond market's cash rate. And finally, we have inflation-linked bonds, where your principal and income keep pace with inflation.